It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm Annabelle Drawlers with David Ingles.
Good morning. Counting down to the open of greater markets in Greater China. Okay, stumble at the top of the show. Things only get better from here. As with equity markets, stocks are rising for a third day as weak U.S. data prompts traders to increase bets on a Fed rate cut next month.
U.S. Treasury is also rallying as Bloomberg reveals the dovish Kevin Hassett is now the front-runner to replace Jay Powell as the top U.S. central banker.
And also ahead here, we're looking at shares of Alibaba, slump in ADRs overnight, extremely heavy volumes there. Its food delivery business is eating into quarterly profits, offsetting gains for its cloud computing arm.
And a fresh challenge for the iPhone with Huawei launching new models aimed at derailing Apple's march toward becoming the world leader in smartphones. We start the show this morning with some breaking news, and we do have a decision from the RBNZ. They have cut their benchmark interest rate by 25 basis points to 2.25%. This is the decision that 21 of 24 economists that we survey had seen, so I don't think it's going to be any surprise. But I think what's interesting as well is that so far they've already said that door is open possibly to further easing to come. They are looking at inflation as well to fall to around 2% by mid-2026. It has been a very interesting time for the RBNZ because they were the front runners in the cycle to begin with, but they've really faced this challenge of you've got lackluster economic growth, you've got weak immigration, soft housing market. They've already had to cut more than expected. What does it mean for the trajectory for rates from here? But of course, to note as well that the governor, Christian Hawkesby, who's going to be giving that presser in an hour's time, this is his last decision because he has been acting in the position. They have a new leader coming in. It is the last decision for this year as well.
The reaction is quite curious, and I have to caveat that by saying it's a bit early, given all the details of the statement are just coming out. The reason I say that is we're actually getting a hawkish reaction in markets, and the Kiwi dollar is underscoring that point. And I'm just looking at the headlines that have come through so far, and if I had to deduce personally what that might be down to, I'm looking at two specific headlines coming through. One is that there is some chance of one more 25 basis point cut next year. So they're probably not done, but some underscores maybe a smaller possibility that that's the case. And number two, that they do see economic activity picking up. And the notion that they might be done in this easing cycle, to the point Bell was making there, that they were ahead of the curve as far as that's concerned. They might be done just right. But yes, well, we'll keep an eye, of course, on more details coming through. And, of course, in the next hours, we were just pointing out, we do have the briefing and hopefully adding some color as to why we are getting this hawkish reaction across these markets. That is also to say, when you look at the benchmark on the Asia-Pacific, we are doing better by about 1%. We're getting Taiwan coming online, of course, and I do expect that to show some green on the screens. A lot of the upturn we're seeing in risk assets, and let's call it reflation, in the risk trade, down to the fact that we are getting a lot more pricing coming through for a cut in December. That's reflected in the dollar. That's reflected in a two-year yield that is very close now to taking out the low that we hit back in October. And below that, we're back to 22 levels on the two-year yield. In fact, just on that very note, we're about 90% priced now for a cut in December. Taiwan coming online. You have the Kospi, you have the Nikkei. Straits Times Index also coming up on your screens. And there we go. As expected, we're better by about, let's call it 1.5% on the benchmarks there. Not the same story, though, that we might see in equities today as far as Greater China goes. We did get some gains on the HXC benchmark. That's the Golden Dragon Index overnight, but of course not as reflective as the broader rally in tech. That might be down to the Baba drag, 2.3%. Hesai, another fantastic day. One stock to watch going into the open today. And futures are coming up on your screens right now, and maybe splitting the difference. Yeah, there we go. So Asia's better by 1%. It's not negative, but we are modestly higher only going into the open today. One other thing to note, the Fed conversations showing up as far as the Yuan goes, which is now at the strongest level going back to October of last year, Bill.
Yeah, maybe the path is set for it to head down to 7. That's sort of the big question now for the currency. But yeah, you mentioned Hassett. I mean, that is sort of the market theme of the day as well. This narrative we're getting is the White House National Economic Council Director Kevin Hassett now emerging as the front runner. That certainly seems to be what we're getting in terms of reporting that we have here at Bloomberg and our sources. But I mean, it's going to be an interesting one to see because Kevin Hassett is someone who's very much aligned with that Trump vision around easing.
And he might not actually have to pull teeth to get people in line with reducing interest rates, right? Because the data is doing that for him. So on top, of course, of more dovish complexion on the Fed, the data, agnostic of maybe who heads the Fed, just as a mental exercise, is pointing to substantial downside there. So overnight, we had retail sales missing estimates. I think we have a graphic that shows you that. We do have, there we go, 90% priced. We also did get the consumer confidence numbers coming through, sub 89 on that specific metric, which actually is the second lowest on that index since Corona back in 2020, and also missing estimates by the most in about a year. So the data's actually turned quite negative, of course, in favor, of course, of more easing coming through out of the Fed. From that, of course, we're also looking at Alibaba. Of course, we're looking at that indicated lower going into the open today.
Indicated lower, I think there's just so many different themes to pick up on in these numbers because, firstly, you had that cloud revenue growth. You continue to see that for a 9th consecutive quarter. I think that Toby Xu, the CFO, in the earnings call was very...
Here's the bullish side coming, by the way.
No, I think I was going to say more around the capex. You know, we didn't really get much more in terms of the capex. What are they planning to spend on AI? But we did actually hear from Eddie Wu as well, saying that he doesn't see any sort of bubble forming in the next 2 to 3 years, and he definitely thinks that there's actually an undersupply of service in the market today. On the quick commerce side, I mean, there was just so much attention on that as well. But let's talk about the market reaction, because ADRs, of course, they dropped, and we're seeing that as well, those indications for the Hong Kong session today. Again, it's really coming down to those delivery wars, the quick commerce wars as well, and the impact that's having puts a lot of focus on the Meituan numbers coming up on Friday as well. But let's get more with our China correspondent, Min Min Lo, this morning. So, Min Min, as we said, lots to unpack, but what is the first focus for you?
Yeah, I mean, it's a very complex business, and I think it's interesting the amount of trading volume overnight was about double the usual volume. It shows you how much interest there is in this company. But if you break down the numbers, the top lines are all looking very positive, whether it's overall revenue up by 5%, that was better than expected. You look at the e-commerce revenue, double-digit growth, 16%. You look at the cloud revenue, that's, of course, the standout sector. It's 34% growth. That is really being seen as the most promising growth driver for the company right now. But then you look at the bottom line, and that's where you see all the pain points, right? Net income was not great. We're seeing the biggest profit slump so far. EBITDA, when it comes to the e-commerce segment, was slumped by about 76%. And the quick commerce platform, that is where we're seeing losses, even though the losses have been reduced by about 50% or so. Some analysts are saying that the losses are still horrifying. And it's because of the billions of yuan that the company has spent on subsidies for merchants and consumers to fight off all that price competition with the other companies like Meituan and JD.com. And so, as you said, a lot of focus is going to be on what Meituan's numbers are going to look like on Friday.
You know, if analysts describe losses on a financial statement as horrifying, I think they're pretty much living a good life, if I think about it. All that is to say, Min Min, let's talk about the CEO dismissing signs of an AI bubble. What do we know there?
Yeah, so interestingly, Eddie Wu said that he doesn't see the risk of an AI bubble forming for the next 3 years. And the reason is because he said the amount of customer orders they're getting on their cloud business is far outpacing their ability to add new servers. That infrastructure crunch is what they're facing now. The supply chain crunch, chips are running at full capacity. And this really echoes what Nvidia's Jensen Huang also said in terms of the demand that they are seeing, right? And in terms of investments, Alibaba already pledged about 380 billion yuan in investments over the next 3 years. That's an old number, but the company did say they don't rule out adding further investment. They are aggressive in adding further investment there, and their priority is going to be on training the foundational AI models to upgrade that to unlock new profits, because we did see the launch of their revamped version of the Quen model. Yeah. It's the fastest rollout of any AI service in China so far. Within I think the first few days, they got 10 million downloads. And I mean, right now, if you compare capex spending, yes, it is head and shoulders above the rest. Tencent is looking at low teens, but it's still below what the US hyperscalers are spending. And so perhaps that's why he's still confident that more spending is the way to go.
Right. Min Min Lo, thank you so much. Setting the stage for us as we go into the Alibaba story. 20 minutes away, the opening bell. And, of course, also joining us at about that time is Alicia Yap out of Citigroup, of course, also coming on to break down the numbers. I think they've raised, I believe, their price target for the stock, get into the weeds of things with her at those times on the screen. Just very quickly, also just to recap the news coming through out of the RBNZ, and the market is continuing this hawkish tilt there. As you can see, the Kiwi dollar is now at session highs. It is now up against every single one of its peers, and that statement does underscore perhaps that this might be, again, to underscore, this might be the end of the tightening cycle, the easing cycle. More on that in a moment. Kiwi dollars bid 0.8%. That takes us straight into other monetary policy issues.
Yeah, exactly. And then who's going to be leading the Fed next? But on that point, Bloomberg's learned that the White House National Economic Council Director Kevin Hassett is firming as the frontrunner to be the next Fed Reserve Chair. That's with the search for Jay Powell's successor now in its final weeks. Our Federal Reserve and economy reporter, Enda Curran, joins us from Washington. So, Enda, thanks very much for making the time to speak with us and talk to us about this reporting, because it is a scoop for us here at Bloomberg. What do we know so far?
Well, it suggests that as the process gets near the end, like you mentioned there, Annabelle, that Kevin Hassett, who is the NEC director, seems to be leading the pack at the moment. And now, of course, he is seen as quite aligned on the economy with President Trump. He shares the president's views that the economy can do with lower interest rates right now. He certainly has been critical of the Fed, both the institution and Fed Chair Jerome Powell. So he's clearly on board for changing up how the Fed operates and thinks about the economy, for example. And he's also been pushing bigger ideas too, for example, making the point that we are in an AI-driven productivity boom, just like the 1990s. And by extension, of course, that means good growth, low inflation, and you can keep interest rates low. So he's clearly sharing a similar worldview to President Trump on the economy now. However, it must be said, a decision on this has not been made. It's not yet final, according to the White House. We know that there are 5 candidates on the shortlist, and that's due to be whittled down a bit further, according to Treasury Secretary Scott Bessent. And the final decision is expected over the coming weeks, perhaps this side of Christmas. But right here, right now, my colleagues in the White House saying that Kevin Hassett is among the frontrunners.
Early Thanksgiving, really, for doves out there. And can you also help us understand what the data is showing? We talked about this very, very briefly. Retail sales, consumer confidence, all pointing to, again, mental, just a theoretical exercise here. Maybe we don't need a dove on the Fed for them to cut interest rates. The data is telling us that probably is the right thing to do.
Could well be. First point to make, though, Dave, is don't forget we haven't had any real official data, right? We're not going to have proper jobs data or inflation data before the Fed meets in December. Yes, there is no end of private sector numbers. There is state level data. All of that in the aggregate does point, however, to the story that you're saying there, which is the economy is softening in pockets. Consumer spending coming off the boil in September, a little bit less than expected. You have mixed signals from the big box retailers, some saying consumers are spending strongly, others saying they're being much more careful about how they go about it. Consumer confidence certainly taking a dip. That's going through the floor on concerns about prices and about job security. We're getting headlines about companies laying off staff. Now, to be clear, equally though, overall activity, the aggregate data is doing well. That's partly because, of course, of the AI boom here. And even if the labour market is softening, well, we don't yet know by what extent it is softening by. The unemployment rate remains low by historical standards. So there's a case here for both sides of this. The hawks are worried about where inflation's at. They're talking about getting back to that target as a priority. And of course, the doves are saying, wait a minute, there's a risk here of being behind the curve on the labour market. It's clearly a difficult call for them as we head into that December meeting in a few weeks.
Yeah, and you did see that market reaction with Treasuries gaining and pushing that 10-year yield down to around the 4% mark. But that was our Fed Reserve and economy reporter, Enda Karan, joining us there from Washington. And we are counting down as well to the open of trade in Shanghai, Shenzhen, Hong Kong. You're watching the China show. We're going to have more on the market reaction. Alibaba's numbers very much the big focus. We could see it dropping as well when China comes online in 15 minutes from now.
All right, welcome back. You're watching the China show. The fixer today is, in the context here, apart from obviously be a daily event for us here, is that you had a very big drop in dollar China overnight. I think the steepest drop in months. It's taken us a 708 handle, 707. In fact, below that as we speak now. Okay, just correct myself there. Risk reversals have also pointed to perhaps more downside on the Chinese currency. On the pair, rather, to correct myself. But yes, certainly something to consider given the dollar weakness out there that's really provided a platform for equities to rally even further. We're up 3 days now for Asian equities right now. Okay, to help us understand where we are in the cycle going into next year, joining us here on set, Mirae Asset Global Investment CIO, Joohee. Good morning. Very nice to see you.
Good to see you again.
Positive for next year?
Broadly, yes.
Okay.
Of course, there are some risk factors to watch, but if you consider the earnings growth, it's going to bottom out from almost flattish this year to probably low double digits next year in Asia, Japan. And also, if you consider valuation, thanks to the recent healthy pullback, healthy correction, now it's not very demanding. It's about the 13.5 times. And also, if you think about some structural changes and trends in the world, which will benefit some Asian companies like the U.S., for example, the U.S. push to diversify their supply chain out of China. There may be some Korean companies and Taiwanese companies that will benefit from this kind of new trend structurally. So this structural issue is not going to go away. And the next thing is the liquidity environment. Also, the rate cut in December, we don't know yet, but the probability is higher. If not, then it will come earlier next year. The liquidity environment also, QT is going to end next week. And then if this banking system liquidity is this tight still, then maybe QE could be introduced earlier than expected early next year. So liquidity environment is also supportive. And then lastly, geopolitical issues, which pressed the market a lot earlier this year, but at least until the first quarter next year, because in April, Ms. Xi and Trump are going to meet. That's what we hear so far. This kind of geopolitical issues also will be relatively muted. So that's why I think, considering all these kind of factors, I think overall at this moment we are going to utilize this kind of the market correction and pullback, year-end correction, driven by taking profit and locking profit demand as buying opportunities for the good and high-quality companies who are going to benefit from these kind of structural changes going forward.
So you mentioned two of those companies, or bourses rather, that are very exposed to the AI story here in Asia. There's Korea, there's Taiwan, Japan as well, perhaps to a lesser extent. But out of Japan and Taiwan, Korea rather, which one's your preferred going into next year?
You mean the regarding the AI things?
Yes, the AI thing, yeah.
In China, now this AI theme is becoming more like a hegemony war between the U.S.
Korea and Taiwan.
In Korea and Taiwan.
Yeah.
So in Korea, obviously now the memory chip related ones, and also the power equipment side. So power, the shortage is it's really like a structural issues that are not going to be solved anytime soon. So we think those two sectors, the semiconductor and the power shortage related names are our topics in Korea. And also in Taiwan as well, kind of similar theme. So it's not just semiconductor, and also other industrial and then tech sectors which are related to the power sector as well. So those are our topics in Korea and Taiwan regarding the AI theme. Yeah.
Just want to ask you, I know you hold Alibaba as one of your sort of top stock exposures right now. I think shares are down 2.5% in the pre-market. What do you make of the earnings? And do you think this is a buying opportunity? Like, how are you going to manage your Alibaba exposure?
It's not expensive, but we do not think that it's a very good entry point to jump in yet. Because, yes, so we are holding it, but just an equal weight at this moment. The reason for that is AI and the cloud business is doing very well and even ahead of the estimates. But at the same time, we see that how strong their spending is on the local services and the consumption businesses. And then originally we thought that maybe third quarter of this year could be the kind of the peak of the spending. But whenever I see the market and the industry experts, and I can see that actually that spending in the competition is not actually getting smaller and getting weaker. So it really depends on the communication and how we hear from the management going forward. For the next 1 or 2 months, we are going to just talk to the management and industry experts. That if we need to see some signs of kind of this reduced spending and the more kind of to calm the competition. Otherwise, even though the top line will be driven by the good AI cloud service, but the bottom line will, if it continues to be disappointing, then maybe this, the period of the big competition, it could be longer than our original expectations.
So even though in quick commerce in particular they managed to increase the average order size, they're bringing down logistics costs, there were some signs of brighter spots. That's not enough for you right now, just given that level of spending on
eventually
on sales and marketing?
It will be positive for the company because they lost some momentum in the consumption areas for many years, right? So maybe if they are going to be successful, putting everything under the Taobao platform and then kind of it's like a rebuilding and restructuring their consumption businesses, which it could be good. So we are positive, thematically, and then from more big picture, but. Again, the next 1 or 2 more quarters, if it's really bloody, and then in terms of timing, because you asked about the timing, so in terms of timing, maybe it's not a perfect timing. Let's wait a little longer, and then let's see how it develops. So fundamentally, we are still positive, but the reason that we are not big overweight in this name is the kind of the issue. So. But long term, yes, that's a proxy of AI in China.
You guys hold it, so yeah. We didn't get to talk about risks, but there don't seem to be any, at least very apparent. we can do it maybe early next year. Joohee on there, thank you so much. CIO, Mirae, Asset Global Investments. In fact, coming up as well, we're going to be having a conversation around Alibaba. Shares are down. Citi's joining us as well, and what their take is, because people seem to be latching on to either side of the conversation here. Hang Seng Index 6/10 to 1% to the upside. The opening bell 6 minutes away. This is the China Show. Good morning.
Taking a look at some of the big movers in pre-market this morning. We've already discussed Alibaba. We had those numbers coming out strong on the top line with the cloud revenue, but weakness in terms of that huge spending on subsidies, quick commerce, delivery wars as well. NIO under pressure because you saw their ADRs dropping as well. Third quarter sales miss as well for PonyAI, or its losses widening.
Welcome back. You're watching the China Show, counting down to the open markets here. Rally across the board. I believe if our camera just caught that, I was looking at our live shot, a butterfly, I think, just crossed the lens there. If you didn't see it, just believe me. It did happen. I'm not seeing things. We're looking at gains. There's a Fed conversation, 90% probability. We have reporting on Kevin Hassett. There's an RBNZ decision that they cut, but the market is reacting the opposite way. We'll figure out why in a moment. Weak dollar story, lower in yields, higher in stocks, earnings story. Alibaba's in focus going into the open today.
I think you wrapped it up really nicely there, actually.
Okay, thank you for joining us today. You're watching.
You can tune off now. No, we do have the market coming online this morning, and I think, you said Alibaba is definitely going to be the focus for the mainland session. But the macro themes, yes, it's very much this expectation that, we were talking about probability of up to 90% and very much a done deal at the start of the week. Now you've got this reporting from Bloomberg that Kevin Hassett could be front in line to take the role from Jay Powell come next year as the Fed chair, and that's certainly lighting a bit of a fire into some risk assets this morning. Still, you're seeing the CSI 300 fairly steady in the early moments of trade here, but that is the picture there as we get the open. What else we're going to watch, though, as we said, Alibaba's the big focus. Let's take a look at the Hong Kong dashboard. We have that because Alibaba revenue in the second quarter, it did beat estimates. We saw strong figures in terms of the cloud revenue, which we sort of expected because you're coming in off 9 straight quarters of those sorts of gains for that business division in particular. Under the hood, though, there were some concerns around just the sheer amount of spending on the quick commerce wars and the impact that's having. So lots of focus on Meituan, which is actually having a very strong start to the session, up 5% so far. But Meituan is due to report later this week, actually closing us on Friday. Other stocks to watch, you're seeing Baidu there again, a little bit under pressure here. But that is the Hong Kong session. As we said, tech is going to be one of the big themes to watch today. And you are just seeing a bit underperforming the broader Hang Seng Index. Earnings as well to note because there's been a slew of those yesterday after the bell. We saw Neo, for instance, to watch. They had a sales miss. PonyAI, you're seeing that stock there improving. It was an interesting one because you saw that loss widening, which I think is a big contrast to WeRide early this week. These are two companies that are very much in competition along with Baidu's Apollo Go. But WeRide and PonyAI in particular, they just had their listings in Hong Kong recently. They're both listed on the NASDAQ as well. But again, this
on the same day, too.
Same day. It was pretty contentious, actually.
Yeah. Not to get into the personals, but
no,
yes.
we'll leave that for another moment.
Yeah.
But anyway, Chow Tai Fook, that's the consumer story. And again, first half net income missing. And Vitasoy there as well. That's the beverages company listed in Hong Kong. Again, we had those earnings after the bell yesterday. But that is sort of the big earnings picture for us, Dave.
Yeah. Okay, let's get some final thoughts right now on markets going into next year. Still with us here is Joohee An, Mirae Asset Global Investments CIO. So we've done well across the Asia ex-Japan benchmark. So a couple of markets have done well. Korea has done exceptionally well. China, Japan. On the other side of the spectrum is India and parts of ASEAN. Do you see a catalyst that flips that order around, or do I lean into the winners? What are your thoughts on next year?
So next year, at least the gap between the AI-related countries and then less AI-associated countries like India and ASEAN could be maybe kind of lower next year. Especially India, in terms of the earnings growth, is going to be double-digit next year. Which is much higher than this year, and also since it started to underperform third quarter of last year, so it's been more than the year. So the premium is also kind of narrower. But at the same time, investors like us, we are starting to assess how much of valuation could be fair in the future, though. So now we are reducing the underweight in India, but at the same time we are kind of trying to assess that they kind of what could be the fair valuation premium that India has enjoyed for the last decade compared to the other countries when we are just going into the AI era, which is very different from the last decade. Yeah.
It's interesting because we had Winnie Wu yesterday from BofA Securities, and she was saying India actually could be the market to outperform if you really see an unwinding of AI valuations, particularly led by the US. But she did also make the point that China is sort of the market that will continue to do well regardless. What's your expectation for China going into next year?
Yeah, so I think China and Korea, both countries actually, they performed pretty well this year. But from more fundamental perspective, I think the investors, they could admit that, now these two countries, they deserve some re-rating further. So for example, like China, because as you mentioned, the China, this year it was driven by re-rating already. So it's slightly above 12 times already. But then that's it. No, I think we still can expect further re-rating from here, plus some earnings growth, which is going to be at least 9 or 10% in our house view. But the Bloomberg consensus is about like a 13.5%. So the next year's the China market is going to be driven by both earnings growth, better growth, and some re-rating. And then just like we saw in the recent, the trade talks between the U.S. and China, and then how steady and how consistent the Chinese government has been when they approached all the global and then the matters. So I think in terms of stability of the policies and also the improving the earnings, and plus some improving liquidity environment as well, because the insurance companies and then some conversion from excessive savings to the investment, and then now that from the global and the regional funds relocation more to China. So I think overall we are cautiously positive on China, and the geopolitical issues, it will be the calm until the early next year, because in April we heard that two leaders are going to meet. So at least, in the near term, that issue is also going to be much less. Yeah.
Joohee, thanks for joining us this morning. That was Joohee their CIO of Mirae Asset Global Investors. And I think also that point that Joohee was just making there on the earnings. Story and this expectation of earnings growth going into next year and underpinning their thesis around China. Very good segue back into the Alibaba theme as well, because, of course, we're watching that stock. So far, it is a bit under pressure in the Hong Kong session. I don't think that's any surprise given the action you saw in ADRs overnight. But let's just take a look at what analysts are saying and their actions on this, because we have seen some moves. Goldman Sachs, for instance, JP Morgan trimming their calls. But Citi has actually lifted their price target, to Hong Kong, $223 a share, up from $216. But let's get more with its Global Markets Asia Managing Director and Head of Pan-Asia Internet Research, Alicia Yap, joining us this morning. And thanks very much for joining us here in studio. I think we can get to the price target in a moment. But in terms of the earnings, I think there was really two quite different themes. There was the cloud story, and then, of course, there was the wars that we see in quick commerce in particular. Which story were you gravitating toward more during that earnings call?
I think cloud will still be the more focus than the quick commerce story, I guess, given, the states of globally, everyone's focusing on AI, on cloud. And then there are 34%, cloud revenue growth this quarter. I would say is actually exceeding, at least our numbers is 28% into the print. I think most of the sell side roughly between 28 to 30%. And then some maybe like investor maybe expecting like above 30 for sure. But I would say 34 is probably at least meeting some of the expectation.
And why are you not worried over the price wars, the negative free cash flow, 2 straight quarters that takes us into the sort of e-commerce space? Why does the former story offset the latter negatives?
Sure. I think for quick commerce, obviously we know the cloud or the benefit or the positive side. But then on the quick commerce, if you look at what they have determined to do starting beginning of May, and then how they step up the investment on the food delivery and then quickly ramp up. Right, and then obviously Meituan started to feel the pressures and all that. And I think more important is that they are reiterating a few times that the loss ratio, right, the loss per order are already improving and has improved in November compared to July and August. So that's why the September quarter, it is a bit of the one-off with the big dip. And then the investment will be peaking for September quarter. Even though it will still be loss-making, but then the December quarter, given it is also a bigger e-commerce quarter in terms of the EBITDA, right, then the loss is improving. So then the EBITDA will actually have a V-shaped recovery.
Yeah, Joohee, who was just joining us from Mirae, made the point that they actually don't think that we've seen the peak in terms of spending or that subsidy spend, but you're actually saying we've passed the worst of it, essentially. That's your expectation?
Yeah, so I think, which I think management actually reiterate a few times, even last earnings call, and then this time, last night earnings call as well. So it's already seeing the UE per orders is improving. I think the only thing that no one's wanted to give the guidance is on the orders volume currently, because for the competitive reasons, okay? Right. That will give you the total of the loss amount. But then the loss per orders is been improving by 50%. That means the loss cut by half. Okay, then depending on the order volume for the quarter, the entire quarter, then the total loss amount could be, slightly different. But it will still be, I think September quarter will still be the biggest in terms of the amount of the loss. Yeah.
It's probably useful that you cover also the competitors, so you kind of have a 30,000-foot view on. Do you look at this as zero sum? Like, how do you look at the competitive dynamics here in terms of being, informing you how Alibaba is past the worst, but are others going to feel then that competitive pinch? JD.com also launched their own thing. So how are you looking at just the three here?
Yeah, I would say July and August for the entire industry in terms of the level, intensity of the subsidy is the peak, right? We are not saying that subsidies are completely go away. Okay, subsidy will still be here. And even I think Baba, when they mentioned the UE improvement, is a lot more from their own operating efficiency and then the density, and also they are having a higher mix of the higher AOV. So the AOV actually grew at a double digit, right? And then the percentage of the non-tea, the non-beverage, is now over 75%. So it's the mix of the operating metrics rather than the subsidy actually scale back. So subsidy, I think they are doing a lot of optimization. So for example, if you are already buying, purchasing, they will probably scale back a little bit. So depending on the user, so they are doing the targeting and optimize the subsidy. But it's not completely go away for sure.
Yeah, exactly. I think you make the point here that Alibaba was making in the earnings call that the average loss is going down. The order mix is improving because you're getting more non-beverages coming into it. They're also getting cheaper logistics fees as they ramp up as well. Does that tell you that Alibaba is actually doing better in this quick commerce war, and you think that they're better positioned to withstand the competition from Meituan and JD? What do you think that this tells us about Meituan's numbers later this week? Because, I mean, the stock's up 5% today.
Yeah, I guess I would say in terms of the determinations from the management team, I think when they set up that they wanted to step up for the investment, I think they're very determined from top to down, okay? And then the executions, given that they do have a lot of cash, right? And then they generate, decent cash flow, especially for their core Taobao, Tmall group, which is, tons of, operating leverage over there, so that they can actually using some of the cash flow to reinvest, okay? The purpose is that to maintain the share, right, for the overall commerce. And also they believe over time, right, this quick commerce, the instant delivery, sooner or later, right, even without, let's say it's not Meituan or somebody else will be coming in, and then for their core commerce, they have to have the complementary, support with that quick commerce, instant delivery anyway, because consumer are actually aiming for that delivery service.
Yeah, concentric circles. It's getting me confused really on how they're bulletproofing the business across many fronts for the future. So talk to me about this then. When you come up with your price target for Alibaba, talk to us a little bit more about how you guys came up with the latest one. Obviously, the stock's re-rated this year. What causes a further re-rating? Do you see that next year? And is this an e-commerce stock or is it an AI stock? How do I look at how I value? What multiple do I attach to a company like Alibaba?
Sure. We're actually using the sum of the parts. So we haven't changed the multiple for the e-commerce part. We are still using the 12 times. So previously and current level also using the same 12 times. The trick is we actually raise our cloud multiple. Previously, we have 5.5 times price to sales, and now we have 6.5 times. And then in reverse, we actually tweak down our international business, given it is slowing, actually faster. I mean, slowing more than what we expected on the AIDC. So we are actually now using the 2 times multiple versus, I think previously we have like over 3 times on the international side. So offsetting that, and then the cash position, I think there's also some of that lift as well. I think we are using what they claim out, because if you're just using the short term and the cash position, then minus all the outstanding borrowing, it is not giving that amount, because I think they mentioned they have $41 billion US net cash. So we are using the way that they calculate. I think there are some of the investment security that consider as very liquid, so they consider as the cash. So there are also some of the components on the cash level that we also using whatever their 41 billion as the net cash. Then we apply the 30% discount on it. So the increase on the price target, I think partly commerce side, we used to model a more conservative outlook on the EBITDA. If you look at what they deliver, even though I think on the headlines they might have missed some of the overall consensus, but they actually beat our number on the EBITDA for both the e-commerce EBITDA and the group EBITDA. So we actually raised a little bit our earnings revisions. So that's why the e-commerce is also slightly higher, and then the higher cloud multiple that give us the higher target price.
Fantastic. Well, thank you for taking us into your model. Appreciate that. It's quite rare we get a really glimpse under the hood. Alicia Yap there, fantastic. Thank you so much. Managing Director, Head of Pan-Asia Internet Research Group at Citigroup Global Markets Asia. Right, we will leave you with a look at these markets. We're doing okay across Greater China. We're doing better when you look at some of the benchmarks, tech-related benchmarks out there. Yeah, so suffice to say, we've got more ahead. This is the China Show.
Taking a look at some of the big movers 15 minutes into the session today. This is autos focused, you can see, but you've got the likes of PonyAI moving to the upside. NIO is under pressure, but all of these companies just reported their figures. Let's get more on this now with our Bloomberg transport reporter, Danny Lee, joining us. So, look, we can start with NIO because obviously it's the one that's unloved on that screen, but why is that exactly?
So NIO, it missed on its third quarter sales, and then on its fourth quarter, that also kind of was wide of what analysts were expecting. But critically, it was able to continue to reduce its losses as it moves towards that pathway to that elusive profitable figure. That trend line still looks good, though, for 2026, perhaps, in one of the quarters, but no, it's still a challenge. What we were able to hear from management is that they were able to increase that final quarter sales forecast to at least up to 125,000 units. Still shy of what the street was looking for, 135,000. And it's critical because the final quarter of the year is meant to be one of the busiest for Chinese automakers as the drivers or consumers rush to the forecourts and dealerships because of the incentives that tend to expire. So, yeah, there is still a lot that the street is disappointed with, and that pressure on the stock. In New York, the shares have been down now 25% in the past 3 weeks, so there's still a lot of pressure for the business there.
You know, this market's making my head spin today. So Alibaba was decent, shares are down, RBNZ cut, Kiwi's up, PonyAI widening loss, shares are up 5%. Can you help explain PonyAI to me?
Yeah, investors are looking at some of the management commentary around one of its mature cities it's operating in, Guangzhou.
Okay.
It is able to break even on a per vehicle basis, and that is significant as, even though despite the widening losses, it may have a recipe for being able to find that pathway to profitability. It's going to be key, though, with its rollout of its next Gen 7 vehicle, the electric vehicle, which has lower costs, more fuel savings that it can lock in. So as it rolls out and broadens its reach into more markets, it should help lock in more savings as it tries to turn those losses into profits at the end of the day. And it's expanding, going from 1,000 units in its fleet by the end of this year. It should exceed that target and should get towards around 3,000 by the end of next year. So there is momentum it sees in its business. I think the question is, can it really execute on cutting down on those losses?
Danny, very interesting, and we don't have time, sorry, to discuss Li Auto, but I should just fact-check myself. It's actually reporting later today, and what's interesting is analysts are looking at bad results, and we've actually seen bearish bets on that stock, surging to a record. So we'll get the breakdown of those numbers later, but that was our transport reporter, Danny Lee, there. And in some corporate news this morning, Dell Technologies has jumped in late trade. That's after raising its annual projections for the key AI server market. The company says AI momentum increased in the second half of the year, leading to record server orders. Dell also increased its shipment projections for the year to $25 billion. That's up from $20 billion. HP shares tumbled on extended trade. That's after its annual profit outlook fell short of estimates. The company also says it will cut up to 6,000 jobs through 2028 by using more AI tools. The cuts will result in about $650 million in restructuring changes. The Chilean copper producer Codelco is said to be pushing for a hike in the annual premium for some of its Chinese customers. Sources say the firm offered to supply some buyers at a premium of $350 a tonne over LME prices for 2026 annual contracts. That would represent a huge jump from the $89 agreed for this year. Codelco's offers typically set the benchmark for the copper industry. We'll leave you with this look here of how Asian markets are faring this morning. We are seeing big moves really across the board. You've got those tech-heavy gauges, the Nikkei, Kospi and Taiwan outperforming what we can see there for the ASX 200, still 0.7% in the green. The Hang Seng as well, extending some gains for the week. But this is Bloomberg.
Right, welcome back. You're watching the China Show. Some movers are coming up on your screens. These are some names related to the PC names. We had a conversation around Lenovo this week. HP, of course, was out a few hours back. Around the numbers, also some job cuts coming through. Some suppliers relatively unscathed, in fact, for the better across the region here. Let's have a look at some top and bottom here as far as Hang Seng Index is concerned specifically. So you have Meituan actually going the opposite way of what you would expect, although if you are leaning towards sort of the negative print on the e-commerce side and competition on the Baba story, the Meituan move does make sense. Let's put it that way. Chow Tai Fook out with earnings, 5.7%. That stock, by the way, has done exceptionally well along with the gold trade, probably why that's doing that. And just looking at benchmarks, about 25 minutes into the cash market session, against the backdrop of a very strong rally across the Asia-Pacific. Decent day on the Hang Seng Index. We're flat across mainland benchmarks, 0.3% on CSI 300. A very strong, doesn't show it, but at 708, a very strong Chinese currency this week.
Welcome back to the China Show. Taking a look at the Hang Seng half an hour into the session this morning. We are continuing to move higher today. The key theme I think we're tracking at a macro level is definitely this expectation. Maybe Kevin Hassett is tipped to become the next Fed chair, so that sets the stage for further easing. You've also had some US economic data that certainly corroborates that need for a reduction in rates as well. So that is playing into the dollar story. That's also playing into appetite for risk assets across the board. But if there is a stock in particular we're tracking today, that is Alibaba. We actually just saw it heading very fractionally into positive territory. It's flipped back into negative, but maybe there's sort of a rethinking around what were the bright spots and what were the negatives in terms of the figures? Because you had the bright spot, of course, in the cloud revenue side, concerns around the spending in the quick commerce wars, but you've got the likes of Citi, and management was stressing this as well during the earnings call, that you've seen the peak in terms of spending on subsidies.
Yeah, they're leaning towards, so they bumped up the price target, right?
Yes.
For one, and they've sort of rejigged their assumptions around their businesses there at 157. And I think the other thing will play out for you later on as well is we had someone from the buy side earlier in the show. And they do hold Alibaba. It's a market weight. They aren't yet overweight because they've yet to see, at least in their opinion, signs that the point Bell was just making is a point that everyone can take, but we can get to that later. The other big story on the macro front is one where you are getting lower rates. You had the RBNZ, you had likely, if you believe futures or swaps, likely out of the Fed, and that's really lifting equity markets today. It's also a softer dollar story. Flip the page, please, if we can. Kiwi dollar is stronger. It's stronger against everything. In fact, there might be something to do with some of maybe the less dovish parts of the statement. The briefing is starting this hour. We'll get more on that in a moment. A very nasty inflation print coming out of Australia. It doesn't show as far as the number is concerned now. Maybe that's down because of the Kiwi strength, but it was quite a nasty inflation print there. Yeah, weaker dollar story, stronger currency as far as China goes. In fact, just on that note, options market, I believe, has never been negative on dollar offshore. It did turn negative this year in risk reversals, 1 year to be more specific, which means the put-call skew spread, it's just more expensive to hedge to the downside on dollar China, and that's pushed this into the negative territory for the first time since 2011. So options traders turn bulls, Yuan bulls to be more specific there. There we go. Okay, let's get more on the FX story today and bring in our EM macro strategist, Marcus Wong, out of Singapore to talk us through. Marcus, good morning. Thanks for coming on the show and the time. What has driven the currency, the Chinese currency, to the strongest in a year here?
Well, yeah, as you pointed out, a part of it is the dollar story that's driven, the moves this week. U.S. retail sales last night, obviously, undershot expectations, and we've seen dovish bets rise for the Fed as a result. But it's not just that, like for the Trump and Xi meeting that we saw on Monday, this continues to build optimism over China and the Yuan. But pulling back all of this is a more robust fundamental story for the Yuan. For example, we look at trade numbers, exports have been one of the bright spots in the economy. Domestic consumption has been slightly weaker, so has been investment, but exports have been a powerhouse. And this has really, supported the Yuan in a sense. Other factors that, analysts have mentioned have also been the significant undervaluation in the Chinese Yuan. For quite a long period, we could say that, the Yuan was weaker than what market metrics would have suggested. PBOC partially kept it that way. But, now this valve is, has room to be let off. And, some, investors and analysts see, in a sense, room for the Yuan to rebound as a result. Let's look at Goldman, for example. Goldman sees the dollar Yuan falling to 7 by the end of the year as a result. But pulling back all this, has been the question of Kevin Hassett and how this will impact the dollar moving forward and the policy credibility of the dollar. I think this discussion has been, taken out of the window for quite some time. But with his nomination, possibly up up again. And if this continues to, weigh on the dollar, I could actually see the, Yuan actually grow stronger from here in 2026.
And so then what does that direction for the Chinese currency mean for its counterparts in Asia in general?
Well, the Yuan is seen as a regional anchor for currencies in this region, partially due to, of course, the trade linkages, but also to the fact that the Yuan has a rather significant rating in ratings in some currencies such as the Singapore dollar. So let's take the ringgit, for example. It's actually the top performer in Asia this year, and some analysts see this tailwind actually continuing next year, partially due to the fact that the ringgit has rather high beta to the Chinese Yuan due to trade linkages, for example. Other currencies that are often mentioned include, the Taiwan dollar as well as the Korean won. Granted, the Korean won is a laggard in Asia, emerging Asia this quarter so far. And it's partially due to the fact that onshore investors have seen strong demand for global equities, US equities as a result. But you peel back at the trade numbers in Korea, they've been quite robust. So what I'm saying is that some analysts expect this net foreign outflows from Korea to slow next year. And of course, if these robust trade numbers continue to hold up in Korea, we could just see we want rebound as a result. And all this will be tied to how China will be performing and the Yuan will be performing in 2026.
Marcus, thanks for joining us this morning. That was our Bloomberg Emerging Markets macro strategist, Marcus Wong, there in Singapore. And let's head back to Alibaba now, because we are seeing those shares again just trending downwards. That's after its quarterly earnings showed its food delivery business weighing on margins. We had a couple of great guests on this in the last hour, so let's just hear some highlights of what they had to say.
It's not expensive, but we do not think that it's a very good entry point to jump in yet. Because yes, so we are holding it, but just an equal weight at this moment. The reason for that is AI and the cloud business is doing very well and even ahead of the estimates. But at the same time, we see that how strong their spending is on the local services and the consumption businesses.
I think cloud will still be the more focus than the quick commerce story, I guess, given the states of globally, everyone's focusing on AI, on cloud, and then there are 34% cloud revenue growth this quarter. I would say is actually exceeding at least our numbers is 28% into the print. I think most of the sell side roughly between 28 to 30%, and then some maybe like investor maybe expecting like above 30 for sure, but I would say 34 is probably at least meeting some of the expectation.
Min Min Lo, our China correspondent, is here with us for the numbers, the key takeaways from the earnings call. Min Min.
Yeah, I think if you listen to the analysts, it's been pretty mixed so far. You have the likes of Citi raising a price target. You have the likes of JP Morgan and other companies lowering the price target. And it's really, these two narratives around whether the cloud business is more important or the e-commerce business. So you have the cloud business looking at 34% gain on revenue. And that is far exceeding expectation. The e-commerce business, if you look at the top line, is also doing pretty well, 16% increase, but at the expense of a lot of spending on marketing and the discounts, hundreds of billions of yuan poured into merchants' subsidies, consumer subsidies to fight off that competition with JD.com and Meituan. So that's where we are seeing, if you look at the EBITDA for the e-commerce segment, slipping by 76% on year. And especially the quick commerce, this is the instant delivery segment, which is a new business segment. That is where we are still seeing losses per order. Granted, it's reduced by half, the losses there, but still some analysts are still saying that the losses there is horrifying. So these are the two stories. Bear in mind, e-commerce is by far the largest segment of the company's revenue, right? It's 50% or so of the business, whereas cloud is just 15% of the business. But this is where we are seeing really the bright spot and where it's growing very, very fast right now.
How does this also put the pressure on Meituan going into its earnings on Friday?
Yeah, we'll definitely be watching that very closely because a lot of Meituan's reaction to this price war would impact Alibaba as well, because Alibaba's executives mentioned that their investment into that quick delivery platform is peaking in this current quarter that just ended. So they will be focusing next on efficiency, on user experience. It seems like they're quite satisfied with the scale of the new user engagement so far. If Meituan is also, coming to an end of that price war, then we could see a lift overall to the entire sector. But again, a lot depends on Meituan. We are expecting them to report losses on Friday as well. So we'll be watching for that. But the question is, what is the new normal? Because Bloomberg Intelligence, Catherine Lim, she did say that we will most likely never go back to the norm of, double-digit 20-25% sort of margins, because you have a three-way fight now. JD is permanently in the food delivery space. So she's talking about the new normal, at least about a third below what it used to be. We're now at single-digit level, by the way. It used to be 20%. We're now about 3.7% in terms of margin.
What a bummer, Catherine Lim. The AI bubble, the CEO talked about that.
Yes, he disputed or dismissed any concerns of an AI bubble over the next 3 years, and he is very bullish about demand. He's saying that the rate of customer orders for its cloud services is far outpacing the rate at which they can add server infrastructure. So they are seeing a crunch on the supply chain. Chips are running at full capacity. He's saying there is not going to be an AI bubble over the next 3 years. In fact, while they have already pledged 380 billion yuan in investment over the next 3 years, he says they remain very aggressive on that spending. They still don't rule out further addition to that investment, and it's far above what any other Chinese companies has spent. If you look at Tencent, what they committed to in terms of capex spending is in the low teens. Compare that to the 380 billion yuan that Alibaba is committing to. So a very, very huge difference in scale. Also, their ambitions is very different, right? Because Alibaba wants to be a service provider for the full stack of AI services, from the infrastructure to the chips to the applications and the AI model. And with the Quinn model that they just launched, they want to turn that into an AI agent so that in the future, you'll be able to use Quinn to book your travel tickets, to order shopping on Taobao, and to have your mapping services there, your education services there. It will be an all-encompassing app.
Yeah, all about agentic AI. We thought it'd be the big theme for 2025, but maybe 2026 is when it starts to become a bit more of a reality. But that was our China correspondent, Min Lo there. And coming up, we're going to shift tack actually to the eco outlook for the region. Right now, we do have that RBNZ press conference underway. We're seeing quite a sharp reaction in the Kiwi dollar this morning. But also just really trying to understand, yes, we got that easing this morning. We just actually had our own reporter, Matthew Brockett, asking very bluntly, is the easing cycle over? We couldn't actually get a straight answer from the governor there. So that is the big question for economists. We're going to be joined next by Morgan Stanley, talking about their outlook for 2026 and why they think Asian central banks are nearing the end of the rate cutting cycle. This is Bloomberg. Taking you back to New Zealand now, where we do have the RBNZ press underway this morning. So this is the RBNZ Governor, Christian Hawkesby, who's speaking here. He is in Auckland for this meeting. We should note that, not Wellington. But he's in Auckland today to talk about why they essentially eased by 25 basis points. That was the expectation very much by economists. And they are saying that, that basically they can look to stay on hold into next year as well. So yes, sort of leaving the door open to easing, but certainly probably keen to sort of end it here. But a new governor will be in a position as well next year.
Yeah, I'm just getting a note here from my producers that he...
No, he is in Auckland for this
meeting. Is he in Auckland?
Yeah.
Okay. Well,
yeah. The reason that...
Why is he in Auckland?
He's in Auckland, actually, instead of the usual Wellington headquarters because of asbestos. Actually, earlier this month, the central bank temporarily shut its Wellington building after what it described as an isolated asbestos disturbance. The issue apparently has been fixed, but the decision was made to stick with Auckland for this meeting. So, yes, that is accurate. Auckland today.
The type of stuff you know. But yes, okay.
Well, I'm just going to say this is, it resonates with me as an Australian because this is exactly the same thing that would happen in Australia. Fears around asbestos, and let's just clear out, even if we know it's safe, we're still going to stick with the plan to steer clear.
Fair dinkum.
That is fair dinkum.
Okay.
All right.
Our subscribers can turn to your terminal for more on what's happening in Wellington. Kidding. Tia Livigo is a function you run, commentary analysis there from our expert editors that takes us into the Fed conversation. You had really bad data overnight. I think retail sales, consumer confidence. We're now at 89% probability of a cut, Fed fund futures or swaps. Our sourcing as well talks about Mr. Hassett as the Fed frontrunner. And if you're in the betting market, you're looking at let's call it 54% probability that that's the next Fed chair. Now, all that is to say, we are looking likely at lower rates going into December. If not December, likely still going into next year. Right, let's talk about what that means for broader markets here in the Asia Pacific. And joining us here on set, Chetan, Ahya, out of Morgan Stanley, here with us to help us understand really everything that's taken place. Just one question on the Fed. Does that affect in any way how you look at Asian central banks, whether or not they will move further or quicker?
No, I think if the Fed stays on the path of cutting interest rates, that does help Asian central banks because we do think that bulk of the rate cuts that we needed in Asia have been already implemented. But there are a few central banks which will do one or two more rate cuts, and the Fed rate cuts will definitely help Asia.
And just on, you're saying cuts, so that implies multiples. What's your expectation going into end of this year, but early next year as well? The stage is set, it seems, for further easing.
For Asia?
For the US, just to then lead into Asia.
For the US, for the US, our US team has taken out the December cut. Of course, things are changing, and so we will see eventually what happens. But more importantly, we are still looking for 3 more rate cuts from the Fed in 2026.
Yeah, okay.
We're wrapping up the year, and most, if not all, economies are doing better than most people had expected at the start of the year. Is there a lot of momentum going into next year in terms of the growth outlook for the region?
For the growth outlook for the region, I think so far, actually, we've seen a proper deceleration in growth because what we've seen in Asia in 2025 is some kind of a K-shaped recovery.
Okay, there. That's the caveat.
Trade does matter for the region, and trade has been good only in tech. If you look at non-tech exports for the region in all, for the whole region, but even for China and almost every economy, growth has been just like 1% cumulatively. Let's call it, it's been flat. 0% kind of growth rates for non-tech segment. And tech, it's great for markets, and I appreciate that. But from an economic standpoint, tech sector doesn't create many jobs. So you don't have a big multiplier effect. And so the non-tech sector being in a bad shape has affected the labor markets, wage growth, retail sales, and the overall numbers are that of showing a deceleration over the last 4 quarters. But we think this is all about to change as the Fed rate cuts come through, and with the lag effect that helps the U.S. domestic demand to improve. We are expecting that Asia's non-tech exports will improve from early next year. And also the trade tensions, which had been the key reason why it was a bad situation for non-tech exports, is now finally, we can say that it's behind us. A bulk of the trade tension is behind us. So both those factors, U.S. domestic demand improvement as well as the trade tensions being behind us, should help that non-tech exports recovery for the region next year.
So we don't need to be concerned then about the weaker or softer sales. For instance, we saw consumer sales in the US overnight. You're confident still in the health of the US economy to drive that broadening out from tech in Asia? And if it doesn't happen, what's the capacity then of Asia economies into region trade to pick up the slack at all?
Yeah, so I think it's part of it is the U.S. story, but part of it is also the fact that, the trade tensions itself. So the U.S. did pretty well in 2025, but as I just described, the non-tech exports growth was not great. So I think to the extent to which the trade uncertainty has reduced and tariff rates have actually also gone down, that is another critical factor, and that stays. And as far as the U.S. is concerned, we are expecting this quarter and the first quarter still to be weak, and we're expecting that recovery from second quarter of next year. So these retail sales are probably anyways just 1 month, and it's a payback from that strong auto sales that we had seen in the previous month. But going forward, we do see that these rate cuts will be sort of lending some support to the domestic demand in the U.S.
If growth does pick up and broaden out, to your view, how do I look at inflation next year? Does that pick up as well?
So Asia has had a different problem of on the inflation front. It's been lowflation problem that has been hitting everybody in the region. And so what we are seeing is that disinflationary pressures will also reduce with that recovery in external demand, which will be broad-based. And therefore, there will be real GDP growth acceleration, but nominal GDP growth will accelerate even more because of reduced disinflationary pressures.
What about China in particular? What are you expecting for the economy there? You've spoken about these easing trade tensions, and that's a benefit for the exporters, but other issues like the property sector, consumer demand, that's obviously been on the weaker side.
Yeah, so for China, I think our main focus is on what happens to deflationary outcomes, deflationary situation. Because if you have economy in deflation, your broader corporate profits will be affected. And you can see that pretty much in the industrial profits to GDP ratio in China, which has been declining. So we are focused on deflation. And the outlook on that will be slightly better than what we've seen in 2025, because this non-tech exports recovery will also help China's exports to be better. And we are expecting them to take up 2 other policy actions. One is on the anti-involution policy. There will be more additional steps being taken. At the same time, we are expecting them to take up some measures to boost consumption. So in combination, better exports, some support via cutback of excess capacities, and then boosting consumption will help reduce this deflationary pressure that we are seeing in China as well, but it will still not be completely out of deflation in 2026. That we think will probably have to wait till 2027.
Your thoughts on Japan, which seems to be in a different, let's call it, inflation cycle to the rest of the region. What is that? How does that story evolve in 2026?
So we think that headline inflation in Japan will reduce because it is largely driven by currency depreciation and supply side factors. And our global macro strategy team is expecting that yen will appreciate in 2026. Down to 147 by end of next year.
That's right, 10%.
And the food inflation aspect, the supply side factors which were driving inflation will also kind of calm down. So we are expecting that the headline inflation in Japan will go below 2%. But the focus from a market's perspective is on the underlying inflation and what is the broad narrative that we have in terms of the reflation that has been ongoing in Japan. And on that front, we do see that transition continuing, either from the supply side factors driving inflation to demand side inflation. It is still work in progress, but we expect more progress on that front in 2026. Which will be quite constructive for the markets because that means that nominal GDP growth is going to be driven more by the demand side inflation pressures rather than supply side inflation pressures.
Right. Chetan, thanks so much for joining us. That was Chetan Ahya there, Chief Asia Economist at Morgan Stanley, with their report, 2026 Asia Economics Outlook from Tech to non-tech. The recovery is broadening, but that's their view. So we'll leave you with a look of how Chinese markets are doing currently. We are seeing those gains still extending to the upside. Of course, Alibaba has been the stock to watch, and it has been sort of fluctuating, but mainly in the red so far this morning. This is Bloomberg.
Right, just to mention, bonds of China Vanke are dropping, in fact, dropped enough to be suspended. They resumed trade at 41 past the hour. More on that in a moment. This is the China Show.
Alrighty, 11:29 a.m. I'm going to start that again. It's 11:29 a.m. in Tokyo, and traders are just about to go into their lunch break, and we are seeing some pretty strong gains here across the board. It's the story around the Fed and this expectation Kevin Hassett could become the next Fed chair. I think the stage, and we've been saying the stage is set anyway for Fed easing at the end of this year into next year, regardless of who's in that top position. Tech story as well that continues to play out, and there are. Well, there's one name watching in particular, and this is SoftBank in the session today, because yesterday SoftBank was very much under pressure, slumping around 10%. SoftBank is sort of like a proxy, I guess, for OpenAI, because it's its biggest direct investment, biggest privately held company as well in the Vision Fund portfolio. Today, you're actually seeing a pretty strong recovery, but some interesting reporting this morning from The Information, and they're saying that by the end of this decade, they see 220 million people paying for ChatGPT. Now, that's, of course, there's the Plus, there's the Pro subscriptions. They cost between $20 rather, and $200 a month, so quite a big range there. But you're looking at 800 million users rather right now. So you're looking at roughly a quarter of those looking to actually pay for that service, again, within a few years.
Okay, that's going to come quicker than you think. It's 2026 already in a couple of weeks. The read-through across the Asia-Pacific, SoftBank's doing better. It didn't do well, of course, yesterday, which was the time I think Ben and I were just musing on where the name SoftBank came from.
That is true.
Right, it was this time yesterday. 1.4% Asia-Pacific. S&P futures are also catching a bounce. The dollar is continuing to weaken. So obviously we had the data, we had the reporting around Mr. Hassett, and then you had just a series of events in the Asia-Pacific. One was the hot inflation print in Oz. The second was the one we just talked about right now, RBNZ, this hawkish cut, then leading to a further weakness in the U.S. dollar. That being said, everything is doing well when you do get, of course, dollar softness coming through. Just to also mention here some news coming through that in about an hour from now, Taiwan will be holding a security briefing. The Taiwanese president will be holding a security briefing at 11:30 today. There we go. High-level national security meeting Wednesday morning. Okay, that is just pivoting us to a separate security story. President Trump says his envoy, Steve Witkoff, will meet Russia's Vladimir Putin next week. That's going to take place in Moscow in a push for a ceasefire agreement with Ukraine. Balazs Pence, our senior editor, is here with us on set to get us up to speed on the latest. And I think we were just having this conversation very recently. This thing seems to be moving fairly quickly.
It is moving quickly. There's definitely some momentum. And the fact that the president is sending out his envoys to talk to both sides and the Europeans does suggest that there is some movement. And the president did sound more optimistic today. He said there are only a few points that remain. But those few points that remain to be resolved seem to be very, very substantial. And the fact that he now says he only wants to meet with Presidents Putin and Zelensky once everything is handled does suggest that that may be a little ways off. And that kind of reminds us of some of the sort of stops and starts previously in these negotiations. If you remember, there was already a meeting scheduled for Budapest which had to be cancelled when it became clear that the two sides were not ready to come to a full agreement yet. So very, very important issues remain. And it does seem like the fundamental issue here, which is what's acceptable for Russia is not acceptable for Ukraine and vice versa, that seems to be really, really difficult to bridge.
And yesterday we were talking about how European leaders are really blindsided by the fact that the US and Russia seem to have been having these talks ostensibly in private and really caught them unawares. But the fact that we've got Witkoff now going to Russia again, how does that sort of complicate the ability of the US to also sell this plan to Ukraine and to its European allies?
It is a difficult balancing act, right? They have to engage with Russia and they have to keep the Europeans and Ukraine on side. And that's exactly what has proven very, very difficult so far. Our reporting today shows that Stephen Witkoff actually coached the Russian side on how to pitch their ideas to Trump. And that's what the Europeans have felt when the 28-point plan came out, that a lot of what that plan contained came from the Russian side, and some of the sentences, some of the statements from President Trump sounded like some things that the Kremlin really, really wanted to hear. So Witkoff going back to talk to Putin again, and Zelensky not being able to talk to Trump around this time does suggest that the Europeans have some concern about which way this is tilting right now.
All right, Balazs, thanks very much for joining us this morning. That was Balazs Pence there, our Bloomberg senior news desk editor. And coming up, we're going to be shifting tack back into the tech space, but Huawei's new flagship phones are due to be released, but seeking to challenge the dominance of Apple and Samsung. We're going to speak with IDC for some analysis next. This is Bloomberg. Turning to some tech news this morning, and Apple looks set to retake its crown as the world's largest smartphone maker for the first time in more than a decade. Counterpoint Research says the outlook's been lifted by the successful debut of a new iPhone series and a rush of consumers upgrading devices. Its figures show that growth will propel Apple this year past its major rival, Samsung. Caixin is reporting that Huawei's reduced the price of its latest flagship smartphone series. It says the premium Mate 80 series starts at $661. That's about $113 cheaper than its predecessor, even as memory component prices surged over the past year.
Okay, well, those are the early indications when you look at pricing strategy. Let's map this out for you as we go into that flagship launch. Joining us now is Nabila Popal, Senior Research Director at IDC. Nabila, thank you so much for joining us. Good morning from the Asia Pacific. Early indications are what?
On Huawei's, launch, I think what we're seeing first and foremost is their pricing strategy, right? The fact that they went lower than last year's model on their Mate 80, especially the Mate base model across the series, right? But most interesting to me was how much lower they are, not from just their predecessor, but how much lower they're going to come in from the what they're competing with, right? The Apple's base model, which is doing phenomenal in China. And I think that's going to make a really strong value proposition for them, not just competing against all of their Chinese competitors, right, who are trying to compete at the premium side, but especially with Apple, who was doing really well since the launch of the 17. So I think that's what's really going to do well for them.
How much do you think that the pricing strategy is just a reflection of the constraints that Huawei faces? I mean, they haven't really had a major breakthrough since the Huawei Mate series that was released back in 2023, when they had the powerful in-house designed Kirin 9000S 5G chip. We haven't seen anything of the same magnitude since. So what does that tell us then?
I mean, it tells us, to me, it signals, it's really interesting because they're doing this amid and despite, right, facing pressure from rising component costs, right? We've seen their competitors, in fact, launch increase in prices, right? So the fact that they're doing this is going to increase pressure on competition. And it shows that they're approaching a very aggressive a move to gain volume share back. And that's going to, essentially them saying that seeing Apple gain so much share, especially in our monthly data, we saw Apple be #1 in both October and November data. And it's showing in our forecast for Q4, we're going to see about double digit, almost 16 to 17% growth in Apple. So this is Huawei coming back saying on their home turf that they want to gain some of that volume share back. So I know that, you're saying that we haven't seen like really a big or strong announcement from Huawei. But we've seen consistent, very strong growth from them. It might not be the high double digits, but it's been, if you look over the last 2 years, we see from all the top 10 brands, they've had the highest volume growth, about 40% in volume growth. So I would say it's still been pretty strong compared to the rest of the players.
And Nabila, what are your initial projections on if they are able to make inroads on market share and volumes? What does that look like for you in, in the premium segment, in the domestic market specifically?
So, in premium, and I'm glad you brought that up, because in premium is really where they are, have been competing neck to neck, right? Especially with Apple. So I think when they had gone down, so to speak, or before their comeback, their share had dropped. So in premium, let's say if we define that as above 800, in the beginning of 2023, their share in premium had dropped to 11% with Apple at 80%. And to illustrate their comeback in that segment at the end of last quarter, 2025 Q3, they gained to 34% share. So from 11% of premium, they gained up to 34% with Apple dropping to 55%. So they're really closing in that gap. And this is where I think this launch is really going to help propel them to gain back that share and start, closing that gap. So they are really growing very aggressive, especially in premium, where they, brand and loyal consumer base is their, their greatest strength, right? And China being their home market is where they will rely on that installed base. There are still a significant number of Mate, users who have 3-4-year-old phones who are going to hopefully upgrade, and that's what they're going to rely on.
It is interesting, though, because as we just said earlier, it's still coming at the time when Apple's latest iPhone series is selling well. They're managing to recoup some of that lost ground in China. You're still seeing a very aggressive price war in that premium segment between the likes of Xiaomi, Huawei, Vivo, Oppo, Honor. I mean, how does Huawei look to differentiate itself from the competition?
So they've been investing a lot. Of course, I think this is where the ecosystem lock-in comes, right? This is the first year where they've migrated their Mate series as well as the entire lineup to their the Harmony OS ecosystem. So they're going to try to bring in users. I know there have been some challenges, and of course, in terms of the processing power not being up to par as arguably as the latest Snapdragon chipset. But still, I think it is really, they're trying to bring in the consumers in that Harmony ecosystem. And I think that's what they're trying to, with their ongoing investments and development that they're doing, they're really going to try to lock users in and kind of rebuild some of the in likelihood to what like Apple has, right? So I think that's what they're going to try to leverage moving forward.
Nabila, I'm curious if you could maybe talk a little bit more about sort of the rising cost pressures on the hardware side. I mean, we just had Lenovo on the show this week, and we were talking about how this rise and pickup in memory prices, for example, and how they're managing that. Just broadly speaking, as a sector, how do you see that playing out next year in terms of cost pressures and also margins?
Absolutely. So we just released our latest forecast. We do think that the rising memory costs and capacity shortages is going to play a huge headwind on the smartphone market, and particularly on the low-end Android, where margins are tighter, right? And that's where we think it's going to create not only just OEMs are going to have to debate between increasing memory costs, and therefore the low end is going to face that pressure more than anything, and therefore the Android part of the market we're expecting to face that more than anything, and thus either OEMs are going to have to pass the cost to and increase prices, therefore pass the cost to the consumers in raised prices, or negotiate in terms of balancing it with other specifications, so reducing and balanced cost, and therefore keep the higher memory cost, but reduce specifications and therefore reduce cost in other places in order to keep balanced prices. But there's going to be a lot of things that the OEM is going to have to navigate in order to avoid raising prices. But I think at the end of the day, it's going to be almost impossible to not raise prices. And therefore, from our forecast, we're expecting a little bit of a shift in terms of the pricing mix. We're expecting a shift in terms of more smartphones in the mid-range and lesser in the low end, and as also a drop in the Android market rather from what we were expecting earlier. So there's going to be a shift in pricing mix, as well as a rise in ASP in 2026.
Nabila, thanks so much for joining us. That's Nabila Popal there, Senior Research Director at IDC. And let's take a look at what's happening in US equity futures this morning, because we did see again that recovery, a lot of appetite for risk sentiment overnight as well, just given, again, going back to that Fed story, but also this rethinking around Alphabet in particular, and really re-entering the AI race, because we have seen a chip type, for instance, with Anthropic, but also just that sort of general sentiment, the reaction we've had to its latest Gemini model as well. So let's get more with our tech reporter, Newly Purnell, joining us this morning. And Newly, I'm a bit confused on this one, I will say, because we have been talking about this sort of rethinking around Alphabet's AI capabilities, and it was initially seen as a bit of a laggard, but now it's really caught up. But in terms of the stock price performance, it's still the best performer in the Mag 7, I think, for this year. So what's the difference between what you see in terms of that broader run-up versus that thinking now is the time when you've got that changed perception of AI?
Right. Well, as one analyst I talked to put it, Google has long been a sleeping giant, and now they're fully awake. I think what it adds up to is several small incremental developments. There's the news about the TPU, the tensor processing unit, chips that you talk about, which of course competes with Nvidia. There is, of course, this deal they've inked with Anthropic, but also suggestions they could be working with Meta. The new Google Gemini, so their new rival to ChatGPT, is drawing rave reviews. People are suggesting it's really good at coding, at reasoning. So that's been a known product for them and seems to be improving. The cloud business, which is supports lots of AI computing efforts, is growing. And then an interesting one as well, a kind of Alphabet Inc., the broad parent company, is making strides with Waymo. It's self-driving service, which competes with Tesla and others. They're expanding into more and more U.S. cities, and they've just gotten permission to be the first self-driving provider to go on U.S. highways. So when you add up all of this, it looks like, as other analysts told us for our recent reporting, that they seem to be kind of in a position to own the whole stack. So everything from chips to cloud computing, to the AI services, and then, of course, they just are able to hoover up an enormous amount of data from users, which is really important in training all of these systems, whether it's search, how people use YouTube, Android phones. So it's all, maybe this picture is coming together of a company that's really well positioned to benefit from a lot of these growing trends.
Yeah, it's interesting because I think Alibaba was making a similar point in its earnings overnight that people were really gravitating toward that company that essentially, as you say, has that full AI stack and maybe better chances around monetization, because when you look at a company like OpenAI and there's the reporting that they're going to have a couple hundred million users that are paying subscriptions by the end of this decade, I mean, that's still, you know, you need to have, maybe you've got that monetization path has to be very strong for a company.
Right, and I think it points to some of the challenges here for Google and some of these other players. First, on chips, as some people pointed out to us, it's not a zero-sum game, so there will likely be many winners, not just one winner. Nvidia, of course, is in a very strong position, but even if Google continues to make strides, it's not as if it's going to be a winner-take-all. That's one. Another challenge, I think, is people have pointed out there's very little switching costs involved in using some of these ChatGPT, Google Gemini, some of the other services. So consumers aren't really locked into one, and so people can easily float around the other. That draws into question how they could be monetized. And then also on the enterprise, people have pointed out that Microsoft is really a leader here in integrating AI tools into people's systems they use in the office. Google is lagging a little bit with that in Gemini. So obviously, and these technologies evolve very quickly, we don't even really know how some of these are going to pan out. But Google does seem to be making strides across a variety of different applications.
Yeah, I guess I mean, with Gemini, there's that question, are they really back in the game? But what are the biggest risks that you see? And I'm also interested in, this has been a challenge, okay, going back to another Chinese company, but Baidu, for instance, we've spoken consistently about maybe cannibalizing their ad search revenue. Is that at all a challenge for Alphabet in this race as well?
It's been something that people have pointed out for a long time, that they have faced the classic innovator's dilemma. They have this enormous world-leading cash cow in their search business, and yet they see, as many companies do, that the wave of the future is probably going to involve some sort of generative AI service. And so many people pointed out, in fact, Google's own previous staff have pointed out that that's been a stumbling block, that they had created a lot of the technology underpinning what ChatGPT is doing, and yet they hadn't, until more recently, been able to integrate it into their existing products. But now we see more and more AI capabilities being incorporated into search. And another analyst I talked to for our recent reporting said it seems that they've overcome the innovator's dilemma now, and they are innovating and not letting it disrupt their main product, which of course is their advertising business. So that this full stack integration would point to the fact that they're not letting their hugely successful search business stop them from innovating on AI.
Very interesting, Newly, and I'm glad, at least from a journalist perspective, to see the AI race is opening up a little bit, and we're going to have a lot more to talk about who's at that leadership board into 2026. That was our tech reporter there, Newly Purnell. And just as we've been speaking, actually, another top story this morning, we do have Kevin Hassett appearing on Fox News. He's been asked about his appetite to become the next Fed chair. He's saying he would say yes if he were asked to take on that leadership position. This is, again, going back to the reporting we had at Bloomberg. We were the first to report that the White House National Economic Council Director, Kevin Hassett, is seen as a front runner to replace Jay Powell when his term ends next year. So we'll have more ahead. This is Bloomberg.
Right, welcome back. You're watching The China Show. Right before we go, we're looking at some defense names in Taiwan. A report out of the United Daily News here reporting that we could be looking at maybe higher budget, drone procurement. They'll know more about this.
Well, I think, I think drones is firstly, you've got two things that are at play. Taiwan is trying to diversify its economy away from that huge reliance just on chips, semiconductors.
Yep.
So they're looking into new high-tech industries or newer industries like drones. Drones, of course, you're seeing not just have the civilian but the military applications. So it's really a numbers game, and essentially, as governments build out their arsenals and their inventories, they're looking for a large range of different drone suppliers.
Yeah.
Taiwan is trying to shift into becoming one of the leaders in the so-called non-red China supply chain. So they're trying to make drones that are completely free of any Chinese parts. And that's the push that they're making. But it's a very competitive landscape because, of course, drone leaders, I mean, you've got those in Turkey, for instance, Israel. A lot of other economies are already very capable of making drones. China, of course, really controlling the market.
And we'll find more, hear more on the story, of course, in about 40 minutes from now, of course, with the briefing out of Taiwan. Just before we wrap up things, just to tell you about Fangke and the tanking in the bonds there. We're now trading at 68. We're suspended right now. We resume trade, I believe, in a couple of minutes here. Of course, that's the halt on the back of a very sharp move in the price. This is the 364 bond that's due in March of 2027. These are local currency bonds, just to tell you about that too. Very quickly, we'll leave you with a look at the big movers here in the Hong Kong markets, and we will see you all tomorrow.